I'm John Lesky, recently retired personal financial advisor and founder of finhealth, a tool to guide you to your financial independence. A key indicator of financial independence in the finhealth framework is the tax effectiveness ratio. It highlights the need to be tax aware when investing in order to avoid paying more tax than necessary. However, the finhealth approach also emphasises that the objective shouldn't be to simply minimise taxes paid on the returns on your investment wealth. Rather, the objective should be to maximise after-tax returns for investment risk taken. It's suggested that this is often best achieved by building efficient investment portfolios, that is, those with the highest expected return for risk taken, on a pre-tax basis, and then seeking to hold those investments in the most tax-effective entities, subject, of course, to any other relevant issues. The popular alternatives for owning investments in Australia are in individuals' names, in joint names, through a company or a family trust, or in superannuation. Given that tax paid on earnings in the accumulation phase of superannuation, under current legislation, is a maximum of 15% and 10% for capital gains on assets held for more than 12 months, and 0% for both income and capital gains in the pension phase for those aged over 60, superannuation is a very tax-effective structure in which to hold investment wealth. As a proxy for tax effectiveness, the tax effective ratio measures how much of your investment wealth is held in superannuation and sets a benchmark of at least 75%, relevant for most people, as a target for financial independence. In this video, we look more closely at the importance of taxation structure as a key element of seeking to maximise after-tax returns on investments for risk taken. We examine the same investment in a portfolio of fully franked Australian shares by different tax entities to highlight the massive role that tax can play. It reveals that significant increased returns that always come with increased risk are required to offset the impact of investing in less effective tax environments. But first, we'll give a brief explanation as to how both franked dividends and capital gains tax work for the tax entities that are considered. Australian Stock Exchange listed companies generally pay 30% tax on their pre-tax income before any distributions to shareholders. When the companies pay their fully taxed profits as dividends to Australian shareholders, to calculate their taxable income, those shareholders are required to gross up dividends received for the company tax already paid. So, for example, a fully taxed or fully franked dividend of $100 is grossed up to $142.85. That is, 100 divided by 1 minus the company tax rate of 30% or 0.7 for inclusion in each shareholder's taxable income. The shareholder is then taxed at their marginal tax rate on this grossed up income, with the marginal rate dependent on the entity that owns the share and receives the dividend. To prevent double taxation of shareholders, they are given a credit or dividend rebate for the company tax that has already been paid, which, for our example, is $42.85. This dividend imputation system means that if a shareholder's marginal tax rate is less than the company tax rate, they will receive the difference in cash between the tax they pay on the grossed up dividend and the company tax already paid. The table shown on the screen now shows the marginal tax rates and after-tax positions of the following 4 different potential owners of the $100 dividend discussed earlier. An individual at the highest marginal tax rate, including the Medicare levy of 47%. An investment company paying 30% tax on income. A member of a superannuation fund in the accumulation phase with an income tax rate of 15%. And a member of a superannuation fund in the pension phase with an income tax rate of 0%. Depending on the tax status of the entity receiving the $100 dividend, the after-tax cash return can vary from $75.71 for the individual to $142.85 for a superannuation member in the pension phase. Clearly, tax matters a lot. Next, the table now shown looks at the capital gains tax treatment by entity, assuming that the company's share sold has been held for at least 12 months and a capital gain of $100 is realised. The capital gains tax rates for each entity are provided in row 1. For capital gains, the company is the least efficient tax environment, with the pension phase of superannuation again the most efficient. With this brief background on Australian taxation, as it generally applies to dividends and capital gains on Australian Stock Exchange listed company shares, we can examine how taxation massively affects the long-term after-tax returns of an Australian share portfolio, depending solely on how the portfolio is owned. An initial investment of $10,000 in an Australian share portfolio is made by each of the tax entities discussed earlier. Their portfolios are held for 25 years, at the end of which they are sold. For illustrative purposes, a fully franked dividend of 3% per annum and a growth rate of 5% per annum are assumed. The choice of returns isn't critical to the results. The chart on the screen now shows how each portfolio grows by tax entity. The individual entity portfolio grows to $50,095 compared with $92,063 for the super pension entity. The after-tax return for the individual is 6.66% per annum compared with 9.29% per annum for the super pension. When account is taken of inflation to examine actual spending power, the differences are substantial. The chart on the screen looks at the growth in real balances for each entity, assuming a 2% per annum inflation rate over the 25 years. The super pension portfolio provides 14% more spending power than the super accumulation portfolio, 49% more than the company portfolio, and 84% more than the individual portfolio. And remember, these differences have nothing to do with investment performance. They are simply due to the taxation arrangements that apply to the different entities. In fact, the pre-tax return differences required to offset the extent to which tax affects after-tax returns are significant. For example, rather than the assumed 3% per annum dividend return, the individual entity would need to receive a pre-tax 6.8% franked dividend return to be in the same after-tax position as the super pension investor, that is, an additional 3.8% per annum return. Alternatively, the individual investor would need to receive a pre-tax growth return of 7.8% per annum, rather than the assumed 5% per annum, that is, an additional 2.8% per annum. These additional returns could only have a chance of being achieved if considerably more investment risk is taken. Such risk also comes with the possibility of significantly lower returns. So remember, it's the after-tax and after-inflation returns on your investments that are critical to achieving and remaining financially independent, you have little direct influence over both pre-tax investment returns and inflation. However, the key message to take from this video is that you can significantly affect the amount of tax you are required to pay on your investments. Our view is you should do this by carefully considering the tax arrangements that apply to the entities that hold your investments, rather than focusing too much on the tax arrangements that may apply to the investments themselves. And certainly, we would caution against making any investment solely on the basis of its expected tax benefits. Tax is only one of a number of factors that should be considered, alongside other major considerations such as cost and investment risk. While we consider the discussion in this video provides some high-level insights into the importance of understanding the interaction between your investments and tax structure, it's not meant to be a substitute for professional, financial and tax advice. We've skimmed the surface, and there are often a number of other complexities to be considered. For example, for most, it's simply just not practical or may not be possible to hold all or even any of your investment wealth in the zero tax pension environment. Trade-offs often have to be made, and some professional guidance may prove invaluable. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally, thanks for watching.